Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Thanks for joining us. I'm Lee Kelso here today with Casey Weade and Marshall Johnson, certified financial planners with Howard Bailey Financial. We're kicking things off today with a look at 7 rules every stock trader may have heard, and even now you still need to follow them even though things have changed so much. We'll explain why. Alan from South Bend is asking a really great question. He's done pretty darn well and he can afford to retire at any time, but he loves his career. So what investment strategy might be right for him? And for everyone in the retirement red zone, you know that 20-yard line, the end zone's in sight. What risks should you be keeping top of mind? A lot to cover today. As I said, we're going to start with the 7 rules that you just have to follow because, well, they work, right?
They work. It's common sense. It's just like grandma's chicken soup. You know it works. You don't know how it works, but boy, I feel better after I eat it. These are things you have to do because if you don't do them, you're going to fail. There's no question. You have to pay attention to each one of these individual rules. We're going to go through each one of them as expediently as we can, but we want to make sure we get through all of them. We also want to make sure that you get some great value out of them and take down some good notes, and you're able to walk away with some good information.
All right, let's start. Number one, sell losers short and let the winners run.
Yeah. Boy, this is a hard thing to do.
Yep.
And this is what we see all the time as people are coming into our office and they're holding on to those losers. They say, well, I'm just going to wait and it'll come back someday. They've sold all the winners and now they're waiting on those losers to get back to even at the very least. And quite often they end up hitting zero. We saw this with a lot of oil stocks over the last couple of years.
Sure.
And definitely even banking stocks, the banking sector back during 2008, people holding onto those things until they go to zero. Some things don't come back. And one of the things that you can do if you're an individual investor, you're a do-it-yourselfer, maybe you're trading on your own portfolio, one thing you can do rather than just saying, well, I'm going to sell my winners when they go up and I'm going to sell my losers when they go down, you need to have some rules put in place and you need to have some of this being kind of automated. And one of the things that we would recommend is putting in some trailing stop losses in place. We can put in a trailing stop loss so that, let's say that stock goes from $10 to $20 and now you have a 25% stop loss. So it's going to continue to let that stock ride as it continues to grow, and it's only going to sell it if it drops, say, 10%, 20%, 25%. And 25% trailing stop loss is typically what we recommend, maybe as low as 20% as a trailing stop loss, in order to make sure that those positions that are rising continue to rise. You let them ride and you don't panic when they take a short-term pullback, and if they take a major pullback, you're still locking in your gains, and you're getting rid of those that are probably never going to rebound.
Have an entry and an exit point. Always know where you're going to get in and where you're going to get out when you take a position.
All right, so number 2, buy cheap and sell expensive.
Yeah. You know, when we buy things, right? If you go out and you buy a car, you buy a house, you're buying a new computer or a new TV. At least I do extensive research. I mean, I get called cheap all the time, or I prefer frugal. Yeah, but I spend a lot of time car shopping. I'll go to 6 or 7 different car dealerships before I land on the car that I actually want. Sure. And I've probably already spent a lot of time in Car and Driver and on the internet reading about those different vehicles, make sure I'm getting the best one and at the best price. But when it comes to your portfolio, are you doing the same thing? Or do you just simply turn on the TV and wait for somebody to tell you what stock to buy, and then you just say, well, he told me to buy it, I'm going to go ahead and buy it? You wouldn't do that with a computer or a car or a home. You would do your research and make sure you're getting the best buy. And that's what you have to do. You have to do the same thing. This is your life savings we're talking about, not just a car.
Yeah, and when everybody is talking about a stock or an asset or a mutual fund, you know, think about going the other direction. So usually once everybody's into an idea, that might be time to get out.
So when Jim Cramer shouts, buy, buy, buy.
You better get there right before he says buy.
You got it, okay. This time is never different.
It might feel different, but I can promise you this, everything, it might be a little different, right?
Sure.
But it has the same rhyme as it did with things of the past. You know, people often say, well, this is a different market than we've ever been in the past. Well, one of the things you might look at, you say, well, the market's getting to all-time highs. This is one of the most expensive markets in history. Well, we could go back to the 90s and find a market that was priced about as expensive as it is today that continued to rise over the next 10 years before it crashed. So we could see a market that continues to rise over the next 10 years, just like then, just like it does now, for a different reason. Back then it was the tech bubble. Right now, maybe it's the TARP and all the printing of the major banks did around the entire world that have injected into the system that we've never seen before. And maybe that's why the market continues to rise, but it's just another irrational reason for the market to rise and another reason for you to exercise caution.
Be patient. That one seems to always fit, right?
Yeah, patience
Be
pays off,
patient, right? There's nothing wrong with sitting in cash. You know, your broker's calling you and saying, hey, this is new good stock or a new mutual fund. You need to put this cash you have sitting in here into this. There's nothing wrong with sitting in cash, and sometimes we have to find a good place for that cash. You know, I myself, I keep a lot of cash on the sidelines because I want to be like those big corporations out there right now that are sitting on a ton of cash waiting on the best opportunity to come along, and it will come along. We just have to exercise patience. But in the meantime, I get to participate in a percentage of market gains. I get to participate in up to 10% of annual market returns without any risk, and I can have my cash back anytime I want. So even if I'm wrong, I still get market returns. I still get some of the market to return to me, and if I'm right, then I'm liquid and I can throw that money in the market, or I can buy some more real estate, or I can buy a business on a steep discount.
You can take advantage of opportunities, and this goes right hand in hand with buy cheap, sell expensive. Everything's pretty expensive today. We can debate that, but the idea is wait for a better opportunity to deploy that capital.
All right. With one notable exception, turn off the TV.
That's right. We can continue to watch our show, however.
Don't turn this off.
No, what we're referring to there when we say turn off the TV, we're referring to CNBC. We're referring to Bloomberg. We're talking about Fox Business, where you're turning on the TV every single morning and every single night, and you're looking at what the stock market's doing in the morning, what the futures are doing, and what it's doing at night, and it's causing undue and unnecessary stress in your life.
Yeah. Turn off your neighbor, too. Sometimes you get bad advice from the neighbors, too.
Okay, this one I think is important, as are they all, really. Risk is not equal to your return.
Exactly. You know, risk is the permanent loss of capital, right? Just because you're taking a certain amount of risk doesn't mean you're expecting the same return. If you have the risk of a 20% loss, it doesn't mean you're going to gain potentially 20%. You know, there's very few even bets that you're going to find in Vegas. You're going to find the same thing with the stock market.
I often find that true for a lot of portfolios that we analyze that are very inefficient. They're taking a significant amount of risk, but they're not getting the return of the stock market.
And that's one of the things we do when you come into our office. We'll analyze your portfolio and we can show you what's my percentage downside, what's my percentage upside, what type of return can I expect over the long term and over the next 6 months with a 95% probability.
All right, one last one, make it very quick here, and that is go against the herd.
Yeah, Marshall already mentioned that.
Everybody's going left, go right, right?
Exactly. With everything's on sale, that's when we buy. Everybody's running for the hills, that's when we buy. And we do those things, and some of those times it's scary to do so, but that's when the big companies typically are the ones that make the most money, and the small investors are the ones that get burnt or are left holding the bag. And I just think it's too important for us to not pay attention to these rules, because missing out on lost opportunity is one thing, but if we make a mistake and we lose a portion or a lot of our life savings, we may never get that back. We can always find new opportunities. We can't just fabricate new cash.
We have to leave it there. A special offer on the table for you right now. Be one of the next 10 callers, and we're offering you a complimentary financial review of your entire financial and retirement plan. It's an opportunity to learn more about your money so that you can make the best decisions possible for yourself moving forward. So for the next 10 people who call 866-482-9559, Casey and the team will make time on their calendars to visit with you and give you your very own purpose-based retirement. Hey, we have your questions coming up next, so stay tuned.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to send me an invitation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
you need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts Casey Weade and Marshall Johnson every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
It's time for viewer questions, and we jump up to South Bend. And Alan, you're first up. Go right ahead.
I have been successful enough to have saved enough money to retire any time that I want. But I really enjoy what I'm doing and don't plan to retire. I'm 65 years old and don't plan to need my retirement funds anytime soon. What should a retirement plan look like for someone in my position?
Cool question, Alan, because you're thinking about a retirement plan for someone that doesn't want to retire.
Yeah.
Right? This seems unusual, but it's really not. I see this quite often with people that come in our office that are, quite often they're business owners, they've ran their own business, or they just love their job. And it seems like business owners are the ones that love their job. Yeah. So they're ready to come in and they want to continue to work, but they go, I just don't know when I'm going to retire, because it feels like, when you get to be 60, 65, 70, what I've found is that these business owners, they've fallen in love with this business. They love it and they're no longer doing it for the money. You're doing it because you just love going to work and it's part of your identity. You identify with it. It's something that you never want to stop doing. And it brings fulfillment and purpose to your life, and there's nothing more important in life than having purpose. And that's what that can provide you with, and if it can, then you shouldn't retire. Unfortunately, there may come the time that you can no longer work. That may be due to health, that may be due to age, that can be due to the economy or any number of different circumstances, or maybe someday you just decide, all right, I've had enough, there's more important things in life. And that may happen to you, and what we do in these circumstances, when we're planning for someone that's in your shoes here, Alan, we're putting together a plan that's typically a short-term income strategy. We're not going to put together a long-term income strategy because we know, hey, we're probably going to work over the next 12 to 24 months. We may want to put into an income strategy that says, if I want to retire tomorrow, I can, and I have enough income to last the rest of my life. I've already implemented my income strategy, and typically, most importantly, it's also a tax strategy along the way. As you continue to work during your, really what should be your retirement years, we have to focus on taxes as well as income planning for the future, and even implementing a healthcare strategy. But having a strategy, no matter where you're at in life, if you're 20 years old, you're 65, you're 85, it's never too late to begin to implement a financial plan for your specific purpose at that very time during your financial life.
Yeah. I recently started working with a small business owner, Casey, and he was in the same boat. He was 70 years old, but wants to work till 75. So we needed to implement a plan that had that flexibility. If he got injured or couldn't work, that he could fall back and create that income. But one thing that we did for him, he was concerned about legacy, he was concerned about long-term care. So he decided to stop contributing to his 401k and start to overfund a type of account for the next 5 years that's going to provide the long-term care needs that him and his wife are going to have. So focus on the needs.
He had that opportunity to fund that because he was still working, and he'll have that taken care of by the time he actually does decide to retire.
Good plan. All right, here we're going to move ahead to Daniel in Fort Wayne. Daniel, what's on your mind?
I have serious concerns over what inflation will look like in the coming years and what it'll do to my retirement income. How do you plan for inflation, and how do I make adjustments to my retirement income to compensate?
Well, Daniel, I think first we have to understand the truth about inflation first, and I think we've been misled, quite often by financial planners or brokers that have told us you need X amount of dollars for retirement because you're going to experience 3-4% inflation rate during your retirement years, and you need $40,000 a year. Well, next year you're going to need $31,200, and the following year it's going to increase, and you continue to need more and more income every single year. And now when you look down at your retirement plan, you need to save more money than you can ever possibly fathom saving in order to ever retire, and you decide you're never going to retire, and you end up not even saving any money in the first place. These are the things I think we need to be cautious about, because these assumptions, these 3%, 4% assumptions of your entire savings dollars, your entire expenses that you're going to need during retirement, I think are well overblown. There's been a great deal of research by Morningstar investment research firm, as well as the American College, that has found found that the actual way that retirees spend money is different than the way we spend money during our working years. You have what's called a spending curve, and what you have is a declining spending curve. Typically during our first few years we have our go-go years and we have our slow-go years, and our no-go years we see a peak up in our expenses. But once we throw inflation into that, on average, the average retiree is going to spend the same amount today as they're going to spend 20 years into retirement. Now that's on average. It also depends on how much you're actually spending. So this is where it makes sense to take a close look at what your discretionary spending is, and the more discretionary spending that you have, the less concerned you need to be worried about inflation. Because if you're traveling a lot, if you're driving multiple cars, you have multiple homes, if you're flying all over the place, if you're going shopping all the time, you're going out to eat all the time, all those things, if you're going golfing all the time, all those things are expenses that you have today that you won't have when you're 85 or 90 or even 80, maybe even you're in the late 70s for that matter. So the larger discretionary expenses you had, the lower concern, the lower factor we use for that inflation number overall. And in the end, what we want to do is we want to put together a plan for inflation no matter what, because we can use statistics, we can use history and say this is the way it is, but we always want to set aside some money that's specifically indexed to give you increasing income in your retirement years. And we take risk with that because we know that inflation doesn't happen overnight. It takes years to have its effect.
We're going to jump up to Napanee, and Francine, you'll be our last caller. Go ahead, Francine.
Hi, Casey. Thank you for taking my call. With major changes expected to the tax code, how do I plan for retirement? It seems everyone feels these will be positive changes for retirees, but I'm not so sure. How are you preparing your clients?
Well, Francine, that is a wonderful question. Expectations are one thing, right, Casey? We've got a lot of expectations. We're hearing a lot of rhetoric. We're hearing a lot of ideas about where the tax code is going to go, and sure, some of those seem very positive in the near term, but I'm like you, Francine. I want to prepare for the worst, and so what we're doing for our clients is kind of looking at the tax code today and saying we know where we're at today, but we also know where you're at, and you talked about this with the last question, is what is your lifestyle spending? Where are you at? Where can we take advantage of the opportunities that are present today? And that's what we can focus on, Casey, is the facts today. I think if we do have a favorable tax environment in the future, we need the flexibility to be able to move and adjust. And that's why we often preach to our clients to have multiple types of assets in the retirement plan, from pre-tax to tax-free to Roth assets. We want to be able to pick and choose a strategy that works best and be flexible.
Take advantage of the things you know you can control and the benefits you can get today. There's things you can do with long-term capital gains today where you can sell things at long-term capital gains rates that you may pay 0% in taxes. Take advantage of a 15% tax bracket, do a Roth conversion. You're paying taxes on dollars that you don't want to pay taxes on today. You can tax shelter those dollars, put them in tax-deferred or tax-free accounts today. Even if tax rates change in the future, you're still not paying taxes on them. So there are things you can do regardless of what happens in the future.
All right, thanks to all our callers. And today we have a special offer for the next 10 people who give us a call right now. It's a complimentary financial review of your entire financial and retirement plan, an opportunity to get an education about your money, because we want you to make the very best decision possible moving forward. So for the next 10 callers, Casey and the team will make time on the calendar to visit with you and give you your very own purpose-based retirement. Here's our question of the day. Just when is it that you enter the retirement red zone? Is it 5 years, 10 years, or 15 years before you plan to retire? We have the answer and what it means to you coming up.
Hi, I'm a certified financial planner practitioner. Are you one of the lucky few that will still carry a pension into retirement? Is your company offering you a buyout or a lump sum pension option? If you're seeking independent, unbiased advice from an advisor that can inform you about all of your options, then look no further. You deserve a lifetime of financial confidence due to a lifetime of income. And at Howard Bailey Financial, it's our goal to help you achieve that. If you'd like to see how a CFP professional can best serve you, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
So when is the retirement red zone? When does it start, Casey?
Lee, the answer is 10 years before retirement. 10 years before retirement is when you enter what's called the retirement red zone. This is when we have to be extremely cautious about what decisions are made, and most importantly, how stock market fluctuations are going to negatively impact the long-term success of your retirement. You enter that 10 years before retirement, what we call the retirement red zone. We need a good plan to get us all the way into the end zone, and so we practice for that 10 years. That 10-year retirement red zone is prior to retirement. Then we have 15 years after we retire that we have to continue to protect ourselves against major market fluctuations. We're going to discuss some research that's been done by a gentleman named Michael Kitces, and we're going to discuss what that research looks like and what you can do to protect yourself in that retirement red zone, 10 years before retirement, 15 years after retirement. You know, let me lay this out. Let's say you find yourselves, maybe you're 5 years out from retirement, maybe you're 10 years out from retirement, and you have X amount of dollars saved. Now, over the next several years, what's the market going to do? What if next year the market does what it did during 2008 or 2001 for that matter, and it takes 10 years to get back to even? That could extend your retirement out an additional 5 years. What if you're already 5 years into retirement and we suffer a major market loss like we did in 1929, 1989, 2000, 2001, 2008 for that matter? I say all those years because I want you to know it's happened in the past and it will happen again in the future. And if it happens again in the future in the next 2 or 3 years, will that put you back to work? Your distributions on $1 million portfolio spending 5% a year or $50,000 a year, but if that $1 million turns into $500,000, now you still need your $50,000 a year and your 5% withdrawal turn into 10% per year. So what can we do and why is this? Well, the reason this is that the larger our portfolio gets, the more impact the fluctuations of the market have on it. That's called the portfolio size effect. If when we first start saving, this blue area, this blue shaded area shows us what effect that new cash contributions have to, say, your 401k or your savings accounts. Now, as you make those contributions, about 90% to 80% of those fluctuations in that portfolio, the size is being affected by your contributions, while in those later years, we're seeing closer to maybe only 10 to 20%. Those contributions can have an effect on the overall portfolio, and about 80 to 90% of the fluctuations in that portfolio is due to not those contributions, but instead the market fluctuations. And now imagine you're taking distributions from that portfolio. So let's talk about what we can do. Well, where that retirement red zone lies, as we said, 10 years before retirement, we've got someone that's 25 years old. They go to age 55. They're planning on retiring at 65. 55, they enter what's called retirement date risk. So you have that risk of not hitting that retirement date due to market fluctuations. Then you retire at age 65, and over the next 15 years, you have what's called sequence of returns risk. Now, I know everyone would hope to make 8% a year, right, during retirement. If you made 8% a year on $1 million portfolio and withdrew 5% per year, $50,000 a year, you'd say, well, I'm making 8%, drawing 5%, I should never run out of money. However, if you have bad returns in the first few years of retirement, and those average returns are still 8%, but we have the bad returns on the front end, we could easily run out of money over even just a 20-year period, averaging 8% a year and pulling only 5%, because the market does not move in a straight line. Now, typically what does move in a straight line is your equity and your fixed income allocation. When it comes to your equity allocation, we often follow the rule of 100. If we're 30 years old, we have 30% in fixed income, we have 70% in equities. If you're using one of those funds, those target date funds in your 401k, that's what you're going to find they're doing. They're reducing that fixed income allocation every single year and increasing your equity or decreasing your equity exposure every year. This yellow line shows us decreasing equity exposure that's decreasing in a linear fashion up until this individual hits age 55 and hits retirement date risk. And now we see a V-shaped equity glide path, as Michael Kitces calls it. We see a dramatic increase in our equity exposure during that retirement date as it quickly approaches, and then we dramatically increase our equity exposure as we get out of that sequence of returns date risk as we spend down that fixed fixed income, and now we're left with that remaining equity exposure during the rest of our lives. Now, if that's difficult to understand, we can flip it around and look at it another way. Another way to look at this is a bond tent or a fixed income tent. It doesn't have to necessarily be bonds or individual bonds or ETFs or fixed income funds that we're using. There's a lot of different ways we can gain exposure to fixed income. And what we can see is we can do the opposite. So we're increasing our fixed income linearly over those first age 25 to 55. Then we're dramatically increasing our fixed income from age 55 to 65, a retirement date. And now we're spending down that fixed income over the following 15 years so that we can defend against that portfolio size effect. And we can see it looks a lot like a tent. So that would be a bond tent or a fixed income tent rather than a V-shaped equity glide path. So two of the same things that we can look at is either reducing our equity exposure or increasing our fixed income exposure. So you have to ask yourself this question: are you prepared for the worst? And that's the biggest question you can ask as you step into retirement. If you're in that retirement red zone, you have to ask yourself, are you insulated against retirement date risk? You find yourself within 10 years of retirement, are you still investing the same way that you were investing 10 years ago or 20 years ago? If you're still working with the same advisor that specializes in accumulation, the answer to that question is probably yes. And I also want to have you open up your portfolios and look inside and exercise caution when it comes to the fixed income that you have. We're seeing in this low interest rate environment, advisors taking on exposure to high yield funds or junk bonds, higher risk bond funds in order to gain higher yields in this low interest rate environment, and increasing equity exposure and also getting higher yields out of the individual stocks. And that means typically we're taking on more risk. So exercise caution, and you have to also ask yourself if you're insulated against sequence of returns risk. Have you made any changes, or are you still investing the same way during your retirement years that you were during your accumulation years?
Well, that's a lot to consider, and I think it's one of the main reasons that we often advocate working with a professional. I don't think John Q. Public is going to be able to digest and kind of get through all of that on their own.
There's a lot to take in, and it didn't used to be like this. It didn't used to be this complex. As I've said, if someone could go out and get a 10% CD, or if we could go buy a 10% municipal bond today that was high quality, then this wouldn't be nearly as complex as it used to be. But luckily, this keeps me employed. Okay? This keeps me employed because we're in one of the lowest interest rate environments in history. Stock market valuations are all-time highs, and not only these are concerns of retirees, but they're valid concerns of yours that you should have, because there's more challenges that you'll face during your retirement years than your parents did. And that requires a complex plan, and not just any plan, but a purpose-based retirement.
So I hope that you'll be one of the next 10 people to pick up the phone and call right now, because we're offering a complimentary financial and retirement review of everything you've got going on in your world. It'll give you an opportunity to get an education about your money so you can make the best decision for yourself and your family moving forward. So for the next 10 callers, Casey and the team will make time on their calendar to sit down, visit with you, and give you your very own purpose-based retirement. 866-482-9559 is the number to call. Hope you'll pick up the phone. And I hope you'll be watching next week. We'll see you then.
Thank you.